Welcome. This is the lecture for Chapter 19, Government Debt and Budget Deficits. This chapter covers some very topical issues. It's not particularly difficult, but I think you'll enjoy it. It also leads very nicely into the next chapter on financial crises. An important question in macro is about government debt. Is it too big? And more fundamentally, how do we measure it? This is debt measured as a percentage of GDP for several industrialized countries. This is from 2014. You can see the United States is pretty much middle of the pack. Here are debt levels for the same countries for 2018. They're much higher, but the United States is still in the middle of the pack. Another important factor in U.S. government debt is that over time its size has fluctuated tremendously. Typically, debt rises during wartime and falls during peacetime, Revolutionary War, Civil War, World War I, World War II. At the end of World War II, for example, debt held by the public topped out at 106% of GDP and then fell until about the 1970s. Here's the data again, but plotted since about 1965. Debt declined as a share of GDP during the late 1990s, which is an aberration. But this is a bit misleading. The mid to late 90s were when we had the dot-com bubble. People thought at the time that tremendous wealth was being created. But when the bubble burst in 2000, about here, people realized that that was essentially an illusion. The apparent strong economic growth that made the debt to GDP ratio go down turned out to be just paper profits, not real wealth creation. Here we see historical data and projections from the Congressional Budget Office, CBO. And as you can see, the outlook is not good. The main problem is spending on entitlements. Entitlements are transfer payments that happen without any additional congressional action. It's spending that's put on autopilot. The big ones in the U.S. are Social Security, Medicare, and Medicaid. Medicaid is a joint program between the federal government and the states that provides medical insurance essentially for the poor. Medicare, by contrast, is a purely federal program that provides health insurance for people over 65. Now, assuming we keep taxes at roughly their current levels, the average of the past 30 years, then by mid-century here, just these three programs will consume the entire federal budget, leaving nothing for federal courts, nothing for national defense, nothing. We won't be paying the salaries of FBI agents. And you can see the largest fraction of that is in Medicare. By the 2080s, the end of this graph, these three programs, unless something changes, will be consuming almost 1/4 of the United States GDP. So how did we get into this mess? Social Security. Let's look at that first. When Social Security was created, and the Social Security Act was passed in 1935, the law said you don't get Social Security checks until you hit 65. But look at how long Americans lived. 1935 is about here. Back then, people died on average at age 60. So most people never received anything. But look at today. This only goes up to 2008, but it hasn't changed much since then. On average, Americans are living today to be about 80. So not only do the vast majority of people live long enough to get a Social Security check, it's not at all unusual for people to receive those checks for decades. And as more people are receiving payments from Social Security, a smaller fraction of the population are paying into Social Security, because as the baby boom generation retires, a larger fraction of the population is retired and a smaller fraction are still working and paying taxes. Since you also pay into the Medicare system in your working years and then get your medical bills paid out of the system when you hit 65, we run into the same problem with a larger fraction of the population having their health care expenses paid by a smaller and smaller taxpayer base. And they're getting those payments again for longer periods of time, decades. Looking just at Social Security and Medicare, because those really are the two big ones, you can see that these two major entitlement programs combined are consuming a larger and larger fraction of the economy, and it's just going to get worse in the coming decades. Let's see. Now, is that level of debt too much? From one perspective, that's a purely political question, not an economic one. But measuring the debt, that is the province of economics. A large complication in how we measure government debt is that it comes in several different flavors. There is explicit debt held by the public. Here, these darker purple bars. You can think of that as the treasury bills you might have in a retirement account. But then there is other debt, intergovernmental debt. These are treasury bonds, but they're a special kind of bond. It's called non-marketable. It means the United States Treasury has borrowed money from essentially other branches of the government and given them these special treasury bonds in exchange. Trillions of dollars have been borrowed out of the Social Security Trust Fund in this way. And then there is a third type of U.S. government debt that's not reflected in any bonds at all. These are called unfunded liabilities. Unfunded liabilities means the government has made promises, usually political promises, to make payments of some form in the future, but there's no dedicated income stream sufficient to cover those payments. These are lumped together here on off-balance sheet commitments. Unfunded liabilities dwarf the amount of explicit treasury debt. The National Bureau of Economic Research estimated, as of, well, this is almost a decade ago now, unfunded liabilities totaling $70 trillion. Keep in mind that as of today, 2020, the entire United States economy is only about $20 trillion. And before we can even get to the question of whether the debt is a problem, we have to first understand whether we are measuring it correctly. It's pretty clear we're not, for a variety of reasons. Let's go through just these four. The deficit, which is the amount that the government is essentially short each year, is not adjusted for inflation. Consider the case where the debt in real terms is constant. So if we're not going further in debt each year, that means the government's fiscal budget is balanced. The deficit must be zero. But if inflation is positive, then the nominal debt will grow at the inflation rate. If you don't subtract out the inflation rate, then it looks like you're going further in debt every year. In other words, you're running a fiscal deficit. So we really should subtract the inflation rate to get a real basis idea of the deficit. When inflation is high, this overstatement of the deficit can be very, very large. In 1979, for example, inflation was 8.6% for the whole year. The debt was $495 billion, implying that the deficit was overstated by $43 billion. Once you correct it for inflation, that $43 billion deficit turns into a $15 billion surplus in real terms. Several other related problems in calculating the national debt are a product of the way the United States government keeps its books. It doesn't keep its books in a way that private companies are required to. Put bluntly, if any major U.S. corporation kept their books the way the federal government does, the board of directors of that company would all be in federal prison. The first way this is a problem is that the government doesn't include anything about its capital assets in its budgeting. If the government were, for example, to sell a national park and then use the revenue to reduce the deficit, it would look like our financial position had improved when it really hadn't. The government, from a financial point of view, the United States government is the largest financial entity on the planet. And yet it keeps its books on a cash basis. You'd expect that from someone with a little hot dog cart or lemonade stand. As I mentioned a couple of minutes ago, there's a massive issue of unfunded liabilities, but those unfunded liabilities are also usually undocumented liabilities. They don't show up in the government's books. Here's one example of how the government plays kind of games with its finances. For most of the history of the Social Security system, the taxes people paid in were greater than the payments going out, so there was a surplus. The surplus was supposed to be saved in the Social Security Trust Fund, so that decades down the road, when taxes were not enough to cover payments, money could be withdrawn from the trust fund to make up the difference. There's currently about $2.5 trillion in the Social Security Trust Fund, but, and here's the problem, every penny that has come into the trust fund has been immediately borrowed by the United States Treasury to pay current bills. And the Treasury has, in exchange, given the trust fund these special non-marketable securities, which you can see an example of one here. I hadn't noticed before. It says at the bottom here, I believe, not transferable. So today, the entirety of the Social Security Trust Fund is held in, they're called special obligation bonds, a type of government bond issued for one purpose. In this case, to replace the money taken from the Social Security Trust Fund. All of these bonds are stored in two loose leaf binders in one filing cabinet in an office of the Bureau of the Public Debt in Parkersburg, West Virginia. This filing cabinet is the Social Security Trust Fund. From the perspective of the United States Treasury, this is not an asset. This is a debt. The Social Security Trust Fund, which is supposed to keep the Social Security program solvent until at least the 2030s, has no money in it. It's a file cabinet of very ornately printed promises. In practical terms, all that money has already been spent. Estimating the total amount of excuse me, of unfunded U.S. government liabilities is very difficult. But this estimate is in the ballpark of what many estimates are. This data is a little bit old, but GDP today is about 20 trillion. The present discounted value of unfunded liabilities calculated here is over $100 trillion. As you can see, this is substantially larger than the GDP of the world. Another problem is how the deficit in any one year should be interpreted. If the federal budget was balanced, averaged over a long period of time, it would not necessarily be a bad thing to have deficits in some years. For example, if we needed to fight a very expensive war, or if we were in a deep recession and wanted to try fiscal stimulus, that could be a good thing. The bottom line is that almost all economists agree that the national debt is getting out of hand. But there's so many different ways to measure it, it's hard to know exactly how big it is and thus how much of a problem it is. There are two viewpoints on government debt. I mean, in very broad terms, the traditional view, and then the view of Ricardian equivalence. From a traditional ISLM Keynesian point of view, an increase in the deficit means either taxes have gone down or government spending has gone up, or both. Both of these imply higher spending, either directly or through the effect on disposable income, a shift right in the IS curve. In the short run, therefore, the increase in the deficit leads to a higher GDP. A larger economy is a good thing. So from this perspective, we shouldn't worry about the national debt at all. Other economists have argued that the logic behind the ISLM model in this respect is fundamentally flawed. The main argument is called Ricardian equivalence because the basic theory was put forward by David Ricardo, a 19th century British economist. Modern work in this area has been led by Robert Barro at Harvard. Ricardian equivalence is the idea that whether government spending is financed by taxes or by borrowing, the effect on the economy is the same, thus equivalence. The essence of the argument is that consumers understand the government's intertemporal budget constraint. If government spends money today and finances it by borrowing instead of by raising taxes today, rational people will understand that eventually taxes are going to have to go up to pay off that additional debt, and the net present value of that debt is exactly equal to the amount the taxes would have been today to pay for the additional spending without any borrowing. Now, for Ricardian equivalence to hold, consumers have to be forward-looking so that future tax liabilities do have an effect on current consumption. There are several reasons to suspect this is not entirely true. One obvious possibility is that Ricardian equivalence assumes too much rationality. It may be that people don't take into account government budget deficits when making their consumption or savings decisions. Ricardian equivalence would also break down if individuals face borrowing constraints. A liquidity-constrained person will consume all of her income and would consume more today if she was able to borrow. If the government cuts her taxes, then she's just able to increase her consumption, and she will not save the tax cut in order to pay the future higher tax. And last, there's the obvious reality that debt lives forever. People don't. If you don't care about the economic circumstances of future generations, then borrowing money today is not a problem, because you know you'll be long gone by the time it has to be repaid. Now, if it is a problem, what do we do about it? There have been many different proposals over the past several decades for a constitutional amendment to require a balanced federal budget. All of them have had problems, starting with the fact that they probably won't work. Just look at the example of state governments. Many states have balanced budget requirements in their state constitutions, and they have been remarkably ineffective at restraining irresponsible state government spending. This should not be a great surprise. Politicians are subject to incentives, just like anyone else. If you want to be reelected, and you know that you can essentially buy votes by handing out money from the Treasury, and you can also buy votes by giving people lower taxes, then your optimal path to reelection is to run a large fiscal deficit. Not a happy lecture entirely, but I hope you enjoyed it nonetheless. See you next time.